So how does a 1031 exchange work? And what are the requirements set forth by the IRS so you can sell one property and replace it with another and do it all on a tax-free or tax-deferred basis? Well, there are a few key rules, but they tend to be both modest and manageable, especially considering your ability to complete the exchange and defer all the capital gains taxes, as well as any taxes which may be due, to the repayment of depreciation you've taken earlier on your tax return. So, let's see the main rules for a compliant 1031 exchange. Number 1. Like-kind properties. All the properties have to be considered like-kind, meaning both the property you are selling as well as the property you are buying must be held for investment or held for income. In most cases, 1031 exchanges cannot include your personal residence. Number 2. 180-day exchange period. The IRS only allows you a total period of 180 days to not only sell your old property, but to acquire all your new replacement property or properties. Number 3. 45-day identification period. Within the first 45 days of the exchange period, the IRS expects you to identify the potential replacement properties in which you are interested. And whatever replacement property you acquire must have been previously identified within the 45-day identification period. There are also 3 identification rules that the IRS created, and you need to use one of those rules in your identification. Number 4. Qualified intermediary. The IRS wants you to utilize the services of an independent qualified intermediary firm who can assist you with the creation of the documents which will memorialize your exchange as well as monitor and distribute your exchange funds during the exchange period. So, those are the main rules. Now, to be sure, there are several other nuances and traditions which are important to understand and which can help streamline the logistics of any exchange. And that is why you should always work with professionals who are familiar with 1031 so you can ensure that your exchange process is both painless and successful. Now that we're familiar with the basic rules of completing a 1031 exchange, let's look at the real benefit of an exchange and why 1031 exchanging has been called the greatest wealth-building tool left in the Internal Revenue Code. Let's spend a moment looking at what experienced exchangers are buying with their tax-deferred sale proceeds. So, what are they buying? Largely, what they are buying are what are called investment-grade property alternatives. These are properties or interests in properties which are always well located and most often professionally managed. Often, these are trophy properties that are leased to well-established credit tenants and which generate a reliable and stable stream of cash flow. Why are these the type of properties that many exchangers are interested in acquiring in their tax-deferred exchange? Here are some of the key reasons. They eliminate the hassles associated with tenants because they are usually professionally managed. They are leased to quality tenants, so typically you never have to worry about receiving your share of the rents. They are available in every possible real estate genre, so you can buy the exact type of property you want, whether that be multifamily apartments, office, industrial, healthcare, whatever you want, and usually wherever you want. You can buy the entire property or you can buy just an interest, sometimes for as little as $25,000. And because they are well maintained and well managed, their potential for equity growth is usually quite good. This means you not only receive good cash flow, or 5 to 6% or more, the property is usually increasing in value as well. And lastly, if necessary for a 1031 exchange where you need to replace your debt, financing those properties is pretty easy. Or in many cases, debt can be assigned to you, so it's simple to keep your 1031 transaction fully tax-deferred. So, the opportunity to sell your current property and defer your capital gain is pretty motivating, right? And the opportunities and types of properties you can acquire have never been better. So, what is the last thing you need to know in order to determine whether you should consider a 1031 exchange? You need to know exactly how much replacement property you need to buy and still have a totally tax-free or tax-deferred transaction, right? Okay, here is the insider's rule for calculating your 1031 exchange math. And we're going to keep it real easy to remember. Here goes. If you want a totally tax-deferred transaction, you need to do 3 things. First, you need to buy a replacement property which is equal or greater than the net selling price of what you sold. That is your sales price less your closing costs. Second, You need to move all the cash equity from your old property to the new property. And third, you need to replace your debt. This means that if you have a $300,000 loan on the old property, make sure you have at least a $300,000 loan on the new property. Do those three things and your transaction should be completely tax deferred. Now, what if you don't accomplish all three things? Well, it means that if you don't buy equal or greater in value, or say you hold back some of your cash, or don't replace your debt, you're going to owe tax on the difference. So that's a relatively quick trip through 1031 exchanging. If you have any questions, don't hesitate to give us a call. Thanks for your time.